Good morning, ladies and gentlemen. My name is Ryan Suter. I'm the Senior Investment Manager here at Sharewise, and we're here with the Readcloud CEO, Andrew Skelton. Now, Andrew's been kind enough this morning to lend us his time and expertise regarding Readcloud and just how the company's tracking and how everything is progressing. So we're going to start things off with a presentation from Andrew, and then we're going to open the floor to a bit of Q&A. As per usual, I've got a couple of questions that I will start things off with. But if participants would like to submit questions for me to ask Andrew, please submit them through the Q&A function on Zoom. Andrew, thank you very much for your time, and it's all yours.
Thanks, Ryan. Good morning, and good morning, everyone. Thanks for joining. So, ReadCloud. We've got a presentation here which we'll run through for you and hopefully generate some discussion afterwards. You've got the permission there. Ryan, can you see that okay?
I can't see the screen currently. If you just want to share it for us again.
Yep. Where are we? Zoom. You're in the webinar. Got it. Share screen. Here we go.
Legendary.
Okay. So we should be up and running.
Good now.
Yep. Great. So ReadCloud, things to like. We've got an established and strong board. Got a healthy mix of shareholders. You can see board and management holding 22% and strong support from investors, leading investors like Thorney and Micro Equities. And to be frank, a valuation that can be described as undemanding. If we move to the next slide, we've got a business overview for you here. So we provide education services to Australian and to international secondary schools. And we provide vocational training to Australian high schools and to Australian industry, particularly in childcare. So we own and operate a software platform that students and educators use to access content and learning materials. So our platform is an open platform, and we distribute content from more than 40 publishers, including the world's leading publishers of schoolbooks, as well as leveraging that same platform to deliver content that we write and own for delivering vocational training into high schools. And that gives us a competitive advantage in the vocational training in schools segment. So we sell schoolbooks, we deliver vocational education and training to high school students, and we deliver vocational education and training to Australian industry, and we're very strong in childcare. So what have we been doing recently? We've set out our recent focus for you on slide 4. ReadCloud is an established company. It's been around for a while. What we have done recently is optimize the margins and put things in place to understand and actually truly unlock the operating leverages in our 3 businesses. So we can now make a genuine assessment of our organic growth options. And this has put us in a position to allocate capital and effort and to execute with confidence that we're generating meaningful returns. And on slide 5, we've set out the revenue growth is here. And things are moving. You can see that from this slide. Things are moving, and they're moving in the right direction. In terms of revenue, you can see an established pattern of growth. And that growth is now flowing through into operating cash flow and to strengthening underlying earnings as well. Also moving in the right direction are costs. So operating expenses are 4% lower than last year. And in the first half, our salaries and wages in eBooks and VET in schools, and that's what supports 80% of our revenues, they were 11% lower than last year. So we've got revenue moving in the right direction, costs moving in the right direction, and it's flowing through to better cash flows, and it's strengthening earnings. So some more things to like, or that we like there. On our next slide, slide 6, this is how we're driving growth. So we've set out here for you our gross margins, and they're good. So you can see the eBooks margin is lower than the other 2 businesses. We're fine with that. Our sort of fixed cost base is pretty low there, and we're just selling books. So we're selling books from publishers. On selling those, there's a margin on that, and most of that margin flows through to the bottom line, and we don't need to really scale that business. We've built the tech, we've built the systems, so more is good in that space. In our vet in schools business, this is been a really strong business for us and is set up really well in the period ahead. We've got especially strong gross margins there. And that again comes about from leveraging that same technology platform for servicing students and servicing teachers and servicing vet coordinators in schools and principals and so forth. So we've got one technology platform. And also because we write most of the content, so we have 49 qualifications that school students can do. For most of those qualifications, we write and own the content, which means we're not paying a publisher or we're not paying a third party in terms of delivering any aspect of that qualification to those students in those schools. So that scales really, really well. And in industry training, again, healthy gross margins, and that varies a little bit based on how many students you have in each course and what sort of qualification is being provided. The other key points on this slide are that we're on track for positive underlying earnings this year and positive operating cash flow this year. So we're excited about that sort of breakthrough. It sets a new watermark for us and a new base for us moving forward. And look, we're confident in our ability to deliver revenue growth against a target of 15%. So the first step in securing that revenue growth was really addressing retention, which we've done. For example, in eBooks, our retention last year was 69%. That's already improved to 91% this year. And we think, again, that's a bit of a baseline for us moving forward. So just a couple more slides to go. We've got 3 healthy businesses where we think we've got the cost right. We understand the markets. We've become closer to our customers. Retention is getting better. We've got good gross margins. We're now self-funding. But what are some upside catalysts? Well, the international market for school books is obviously huge. Our technology solves a problem for international schools really well. And we're probably in round 1 of establishing, well, how strong is our offering in that international market? If we can generate some growth there and really validate our product for the international market, that could generate quite a bit of upside for ReadCloud. We're also looking at opening the door into New South Wales schools. We're pretty strong in Queensland in terms of selling textbooks to Queensland government schools. In New South Wales, we were not too long ago accepted, or we're able to sell our technology now into New South Wales government schools. And we're in the process of earning the right to be able to sell textbooks or learning materials or learning content into New South Wales government schools. That will also help with some upside if that comes through in the coming months. I think we're going to see, and certainly will help us, is an uplift in the number of vocational training qualifications delivered at each of our customer schools. And one way that's come about, we got into this business through the acquisition of 3 independent training organisations. They're listed on the slide: AIET, COSAMP, and Rip and Lee. They've been marketed individually. One competitive advantage that we have that is absolute fact is we offer 49 different qualifications to schools. That is a broader range of qualifications than any other provider. So we've got a really concrete competitive advantage there, but we haven't previously been leveraging it, as in selling and acting as ReadCloud that provides that whole suite. We've actually tackled the market as 3 individual RTOs. The early signs are, and we won't really know this until we get closer to the 2025 school year, but it looks as if the number of qualifications delivered per school, which at the moment sits around 1.7, 1.8, I think that's going to increase, and that obviously with an 85% plus gross margins in that business, a lot of that's going to flow through to the bottom line. So that's a good area of upside for us. The other thing we focused on is year 11 and year 12 in vocational training. We're, again, strong in that market, good range, but can we expand the market? Why should a kid have to choose, I'll be an electrician rather than a plumber, when it turns out maybe they want to be a chippy? So we figure that starting taster programs or pathway programs in year 10 which is funded by government or even in year 9 for some schools, helps create that sort of credibility and establishes more choice, so that when the kids do choose a pathway in vocational training, they've had a look around and they've been able to choose a specialty that is going to stick and be more valuable for them. We think there's good opportunity there to broaden our market. That's a product that we've just launched this year. I think we'll get some traction next year, but it may be also in 2026 once schools have adjusted their timetabling to enable that to happen. We're also in our vet business, our vocational training business in schools, very strong Western Australia and Victoria. So we have sort of a toehold or a beachhead into the other states, but really looking forward to gaining some traction in a third state, then a fourth, and so on. Probably the most likely candidates for us in the near term, or based on our sort of leading sales for next year, look like Queensland and NT, but I think we can grow that business geographically. And childcare has been a really happy area of focus for our industry training business. We've got some wonderful partnerships with some leading providers. One of the reasons we can do that, I mean, sure, we focus on service, right? We really do believe we can differentiate on service, but in childcare, one of the, again, demonstrable competitive advantages is that we can access funding arrangements we've got arrangements in Queensland, we've got contracts in New South Wales, Victoria, and also in South Australia. So if you're a national provider of childcare services or early childhood education and care services, we can, in all likelihood, service you more holistically than most of our direct competitors. So building on those partnerships with national providers, that's an area of upside again for ReadCloud. Just finally, but on slide 8, we've set out how we've positioned ourselves to grow from this point forward. I mean, we're all aware of the forces of digitization. That suits our business. We have that software, that learning platform, that technology that is digital first. So we're not a bookshop or a book provider or someone that services schools that's trying to go digital. We're actually a digital first. We started digital. We're digital first. We can give you physical books as well if you like, but we focus on digital. We think there's tailwinds there. Kids are learning through different styles of content. The publisher power is, I think, decentralizing as the printing press behind the scenes becomes less and less relevant. And we're a really natural home for that style of, here's a link to a YouTube, or I'm going to block out this bit of the text, the theory's changed, or I'm going to augment it with this bit, and we have live chats inside the textbook and so forth. So that digital first approach to education and learning, or the providing or serving up the learning materials, really suits us. I think that's a tailwind. We do have some really demonstrable competitive advantages in terms of the range and scope of the qualifications that you can access in our vocational training business. We own a lot of that, so we've got really healthy margin, which is going to help us reinvest in the business for growth. We think there's tailwinds in vocational training. We need more skilled workers in this country. We see the standing, well, in Victoria, for example, there's been a shift away from the pure academic sort of year 12 to VCAL with vocational majors and so forth, now part of the vernacular. We think that continues, and there's certainly, if your kid wants to be a plumber or an electrician now, you're probably thumbs up. This is healthy. This is good. So we like those tailwinds as well in vocational education and training. We've got some clear advantages. We like that our technology is leveraged across our whole balance sheet. Look, we've got no debt. We're now generating the cash we need to grow. And the leverage is starting to be unlocked with those gross margins, with the cost base sort of set, with the right team in place. We think our growth now starts to flow through to the bottom line. So pretty well placed. We have focused on execution, getting our cadence right, getting closer to customers, retention's sort of locking in, and probably create some optionality for us moving forward in terms of, are we investing back inside the business for organic growth? Certainly, as time progresses, we'll keep our eye out on acquisition opportunities that might accelerate things. But yeah, we're had a pretty progressive, healthy year. It's a happy place right now at ReadCloud, and very much looking forward to see the results of the 2025 school year. So thanks, Ryan. That's it from me.
Thank you very much, Andrew. Really appreciate the presentation. So we'll just move into the Q&A component of the webinar. Again, participants, if you have any questions you'd like me to ask Andrew, please just submit them away through the Q&A function. I'll just start things off. Now, obviously, you know, the company ReadCloud has seen improvement, especially in the performance regard over the past 12 months. What do you think have been the key drivers, you know, in that improvement? And then moving forward, do you think those key drivers are going to maintain to be the key drivers, or do you think there are going to be other aspects of the business, like you've spoken about, that are going to unlock further leverage and enhance, you know, higher rates of natural growth?
Yeah, I think in recent times, it's as straightforward as becoming closer to the customers and really rebuilding our business from the outside looking in. Like, what's right for a student, what's right for a teacher, what's right for a principal. Like how are we actually making ourselves useful and solving problems for the users of the technology. So that has been a real focus. I think perhaps what's changed, it's challenging. I mean, ReadCloud brought together 5 businesses, right? So there's a ReadCloud eBooks business where it started. It's acquired 3 businesses that deliver vocational training into high schools, and it acquired a training business that services industry. So we had 5 businesses, and integration is a real thing. It doesn't just happen by itself, especially when you want to leverage technology and processes. And I think we took a rigorous approach to that integration, but you're naturally kind of internally focused, and you can miss some of those sort of really rich engagements with customers, which set you up. So I think it's just a rebalancing of being market focused. We're seeing it with retention. We're seeing it in the type of discussions we're having with schools and stakeholders leading into next year.
Okay. Well, thank you for that clarification. Now, obviously, you have discussed how previously you were fairly, you know, invested in international schools. Is it something that the business is rather exposed to, or sales are dependent on? Or is it just a large component of the sales aspect?
It's an upside thing for us. So we're looking at it. What we really like about our technology is it solves 2 things really well. So if you're a school that has students in more than 1 location, we're perfect, right? So our King's Inter High, which we speak about in some of our materials, it has students in 62 different countries. It's very difficult for that school to come up with a physical book distribution network where every kid's going to end up with the right edition of the right book in the right language and so forth. Then our technology is, I mean, this is just what you would expect. It translates into 100 different languages. There's text to speech. There's all the things that make it useful in that sort of multi-country context. But it's mainly the distribution. The school, the teacher knows that every kid is looking at the right version of the right book at the right time. You literally click on your timetable to open your class, and it's all there. The teachers can augment it. The kids can ask questions to the whole class, or if they're shy or they just want to engage directly with the teacher, they can do that privately. But it's that distribution, it's solving that distribution. The other thing we've noticed, well, we sold into the Ukraine and Democratic Republic of Congo in the last 12 months. And it's challenging. Those, I mean, unfortunately, those people can't just walk down to the bookshop and expect to get all the stock that they need for their education. So if you're in a challenged geography or you have kids in multiple places, the technology is really good. Now, the key point is the technology is really good. So we want to win in Australia, right? And we see there's real upside for us in Australia. What we're exploring at the moment in the international market, well, what do we learn and how do we allocate our effort, our capital between international and Australia? So it's sort of upside optionality rather than our near-term success being dependent on that coming off.
Okay. Now, obviously, you just said you're focused on Australia, but obviously with, the two examples that you provided being internationally focused, is there potential for ReadCloud to begin to target, a larger sales volume or a larger product offering potentially overseas?
There is, look, we're pretty well placed. We have the arrangements with publishers. They're not a given. We've got the technology that can be used sort of anywhere, anytime. Pretty fast setup, pretty low setup, pretty low ticket to the match. We can provide the learning materials without necessarily having to be integrated into back-end systems of schools.
Yeah.
So it's a really viable alternative. If someone wants to go digital, it's almost just plug and play. So we like the international school space, but our team, we're focused on winning in Australia while we explore, well, how do we develop these relationships with the international schools? We've got quite a healthy runway with international schools. They generally start with 1 or 2 year groups, or maybe 1 or 2 subject areas, and then it expands out. So we're going to know pretty quickly, well, do we actually invest in having a dedicated sales force to grow the international market more quickly? But given where we've been and wanting to get through to that breakthrough positive underlying earnings and being self-funded and generating positive operating cash flow, we've been quite focused on, well, let's get the answer with the 5 international schools we've got on foot at the moment. Let's track that growth. Let's see what works so that when we do invest in accelerating that, we know that it's going to work and it's going to be the right use of capital.
Okay. And just speaking on the topic of, dedicated sales stream and RCL sales strategy, what currently when it comes to, expanding product offerings or client retention, what is the current sales strategy and realistically, how effective do you think it's been compared to other competitor sales strategies?
Yeah, I really like it, Ryan. It's pretty basic. It's just service.
Yeah.
Because if you're selling a book, right? So for the eBooks business selling into schools, we probably don't write that book. It's coming from a publisher, Oxford University Press, Jacaranda, whatever. A publisher writes that book. The school's buying the same book for pretty much the same price, and it's choosing who it buys it from.
Yeah.
So we literally have focused on retention so that our people are engaging with schools proactively. We've got a super fast turnaround on their inquiries.
Yeah.
We're really helpful for a lot of people are accustomed to buying the school books themselves or for their kids.
Yeah.
A surprising number of schools in Australia actually own all the school books, particularly government schools. Queensland and New South Wales generally own the school books. So you've got librarians or different dynamics which manage this big field of books. So we've been really leaning in on, well, how do we make life better for them? How do we remove friction for them? How do we make their resources go forward? So for example, if you have 200 kids studying Year 8 geography, we don't just sort of dumbly sell you 200 copies of the book effectively or licenses for the book. We say, hey, actually, you only ever have 3 courses in your timetable at once studying geography. So we can buy you 60 licenses and everyone's going to have the access they need at all the right times they need it. So it's really that leaning in by focusing on retention. And we saw that big jump. I think I mentioned it, 69% a year ago to 91% this year. Now we're starting to see the referrals. And, educators move around. They like the fact that we're removing friction. They like the fact, this is not a big company. We actually pick up the phone. They know the person they're talking to. And it's starting to resonate. And we're seeing that in just the level of engagement and the level of inquiry. So it really is that simple, Ryan. Look after the customer and see we're not the big guy. So we actually have the advantage as this thing grows.
Okay. And then obviously, with leaning in and really increasing your client retention rate, when it comes to your competitive advantage, is that kind of the only facet that RCL presents compared to its competitors in the space?
Look, the competitive advantage, I get quite excited about the technology in the platform. So a single login integrated with a timetable, the kid clicks. There's all sorts of functionality because it's digital first. We're not sort of trying to cobble together a bunch of different stuff from. But you know what? At this point, for whatever reason, the schools, what resonates with the schools is dependability, high level of service, getting the right kid, the right books at the start of the year. And so we've really focused on within that first week of the school year, and for some of the senior years that starts in September, we're now nailing that. They just want, they're still kind of broadly thinking it's the same book. I'm getting it at the same price. What's the service? Some principals, deputy principals, sort of heads of learning, heads of curriculum are more interested in all the features and functionality, but I think that's a stage two. Right now, the area of focus that really captivates the attention is the service and the efficiency and the integration with their timetable.
Okay. Okay. Thank you for that clarification. Now, I'm just going to move on to the last question I've got here, and then I'll jump to a participant question. Now, just to address the bit of an elephant in the room, obviously the share price has fallen fairly largely over the past while. Realistically, what are the company's plans to an attempt to correct the downward trend in the share price and obviously the associated market cap?
Oh, well, our plan is to grow our revenue. Our targeted growth is 15%.
Yeah.
And we're confident we've got levers to deliver that. The costs are moving in the right direction. They're now set. We've got high gross margins. In our view, our job is to deliver a business where the top line is growing, the costs are stable, and we break through into positive territory. So we're positive underlying earnings and we're positive operating cash flow. From that point, revenue growth, cost in control, high gross margin, that feeds through to the bottom line and creates optionality in how we invest in accelerating growth. Right, that's what we focus on.
Yeah.
We focus, and to get there, there's things like retention, there's things like the quality of engagement, there's things like understanding the competitive advantages and challenges and being connected with your market. That's really where our focus is. I think we'll deliver a business with healthy, enduring top-line growth, with discipline around costs, with some leadership in areas of technology and range and scope, a building reputation for service and retention and engagement. I mean, it's up to the market to decide what that is worth.
Of course. Of course. Realistically, when do you reckon the company will be able to present, essentially just net positive cash flow?
So we put a marker in that our financial year ends at September 30. And so shortly after September 30 this year, that's where we've put our marker in to say, at this point, we're positive operating cash flow, positive underlying EBITDA. So we're actually right on the cusp of that.
Okay, well, I'm sure the market's going to appreciate that update. Now, I'll just move to the last question we've got here today. Now, we've got a participant that states that the former ASX listed training business Vocational is an example of what can go wrong in the VET sector. What are the key risks associated with Readcloud, and how might you go about mitigating these?
Yeah, sorry, I just missed the first bit of that.
So the first one was the former ASX listed training business Vocational.
Oh, yeah. Oh, there's a litany of them. Yeah, there's a litany, right? What I'd say is, guys, our vocational training is focused on high school kids in Australia. Like, this is a high care, high touch. So this is very different to international students. In fact, I'd say, guys, we're in the education sector. There's a couple of things I love about it. One is very resilient to sort of economic shocks, very stable. You've got a sort of growing activity, but we're focused 80% of, well, most of our revenue is coming from a focus on Australian high schools, right? So it's not caught up in the international students of sort of sham degrees or whatever else. We've got principals that we work in lockstep with. We've got vet coordinators that, I mean, some of these schools are really big businesses. It's a competitive field. They're choosing between TAFE, being a registered training organisation themselves, or a business like us partnering with us. So we've established now for a long period of time sort of excellence in compliance. We treat that really seriously. We're dependent on it. We're not trying to just milk sort of government subsidies or milk international students for, you know, differing levels of genuineness in terms of what their vocational training is going to deliver for them. So I'd say very different, really robust. We like the tailwinds in the vocational training sector. It's certainly its standing within schools in Australia is building, not declining. And we see the engagement from industry that we're getting in terms of the professional learning we do for teachers, the willingness of industry to give us feedback about what they're seeing in graduates or students that are turning up to work. And some of that's really practical, but really meaningful in terms of reinforcing the quality of what we're delivering into high schools. So yeah, sure, it's been a noisy space in some sectors, but delivering into high schools in partnership with the schools themselves, I'd say it's a thoroughly different kettle of fish. In our direct industry training business, I mean, that's a strong business. That's got really high levels of engagement from like high quality industry-based partners. We mentioned some national childcare providers, for example, and there's some aged care providers, real estate chains, and so forth. So it's not really just getting the students, getting a fee-for-service qualification and then flicking them off into the wide world. It's more industry partnership. And we use obviously the same technology, the same caliber of learning materials and the same compliance systems that we use in the vetting schools. So yeah, there's work in that regulation. There's work in maintaining those standards. We like it. We sort of think the higher that burden is, the less rat bags you get in the sector, and you kind of have a competitive advantage if you can handle that compliance well and in a manner that actually is resulting in a higher quality and caliber of education, because it's more connected with industry, because your trainers are more, their knowledge around industry trends is more contemporaneous, and you're leveraging up-to-date, meaningful materials, the learning materials as you deliver those courses. So we actually see that as a bit of a weapon rather than a threat.
Okay, well, I really appreciate that clarification, Andrew. Now, realistically, that about wraps everything up. So before we just close things out for the day, is there anything you'd like to finish it off with, Andrew?
No, I just want to get back to work. We're sort of having fun here. It's a good team. Look, I'm kind of a year in, really supportive board. There's good tech, and it's a happy space. Like, education is a good space. If you're doing it well and you're engaging with the stakeholders, you know, it's a good sector to be in.
All right. Well, thank you very much, Readcloud, and thank you very much, Andrew, for your time. Ladies and gentlemen, enjoy the rest of your day. Cheers.
Thank you.